Good morning, good afternoon, good evening, whatever time of day it is, wherever you are. Welcome to Monday's Crypto Blast. Yeah, it's Monday. Blink and you miss it for the weekend, unfortunately. Well, I suppose maybe not. Doesn't really matter to you young whippersnappers that are involved in crypto markets where the markets never sleep. As usual, myself and the awesome Cam from Institutional Fi, well, mainly Cam, we'll be going through the latest market moving news, flows, and market moving events, etc., in crypto markets. As a reminder, this is crypto with as Cam has put previously, a tuxedo t-shirt on. So trying to stay away from the fart coins, the meme coins, etc., and focusing on what's actually moving and shaping crypto from an institutional, more, that kind of landscape. But before we do, I'll crack on with the legals. As usual, nothing discussed on the Spaces session. Spaces, old school podcast session. It's trading and investment advice. We're not endorsing any particular brand. Although if someone does want to sponsor us, we are open to checkbooks and wallets. So give us a shout. Enough of that bollocks. And obviously also this is recorded live, so apologise for swearing that you might hear occasionally from myself. But Cam, how are you, my dear friend?
I'm very well, Ryan. How are you doing?
I'm very well. Remember, we are live, so no saying shit, fuck or bugger.
There we go.
What's been happening? We're still above 100 and everyone's still being doomsaying recently. But, zoom out. If in doubt, zoom out.
Well, that's exactly. We're actually going to touch on that to start off because
I like it when you touch on me.
Well, the first time that's been said. Wait. Yes, I suppose let's jump straight into it. Like a little
You said that before to me as well.
Also,
oh, you can't believe I'm nearly 42, can you? Still got the mind of a 13-year-old.
I just had my 27th birthday over the
weekend. You've dropped that in to make me feel like a right bastard. I apologise for not wishing you happy birthday. I'll make it up to you.
That's okay. Buy me a beer. Anyway.
Yeah.
Anyway.
Sorry. Sorry. What are we here for again? Oh yeah, crypto.
The crypto blast. That's what it is. So I'm sure as we're well and truly, underway into October, quote unquote, Uptober, Downtober.
Oh, I tell you what though.
Go on.
As our dear friend, mutual friend Jesse pointed out on the Friday Fix, obviously on Friday. Oh, what did he call it? Choptober.
Choptober, I like that one.
Yeah, so did I. So much so that I refused to believe it was him that invented it, because we know what Jesse's like.
Probably saw it on LinkedIn somewhere.
Yeah, that was my thinking exactly.
Oh dear. So despite Choptober, coined by Jesse, Bitcoin's currently priced in at $111,378. In fact, ticking upwards as we speak currently, recovering well from the October 10th sell-off that saw BTC drop more than 15%, in a matter of moments, following a series of posts from President Trump regarding tariffs and the ongoing saga that is the US-China trade war. Now, these posts came in after the US stock market closed and came into that lowered volume in the crypto sector as well. Now, what exactly caused the crash on the crypto side? Because the traditional markets fell around 2%. Why did Bitcoin and the rest of the altcoins retrace? Some retraced over 90% in their value, an extraordinary amount. Well, it's very difficult to pinpoint and identify the exact root cause. And why is that? Well, in reality, there were multiple factors that led to the sell-off. We mentioned a few weeks back a growing trend in perpetual futures. Remember, Q3 saw over $1.2 trillion in volume on perpetual futures alone. Then there was, exactly. And then there was the liquidation factor. So obviously, as Bitcoin dropped past 5% in a short time frame, we are talking a matter of moments, traders were getting margin called, which added pressure to exchanges as they needed to cover liquidity. This triggered a protocol across several exchanges called ADL, auto-deleveraging. A lot of people were in the blank of this as to what it was, because it's never really been used too often on the large exchanges. So what does this mean? Well, it meant that in order to cover the losses of those getting margin called on their long positions, the exchanges would actively close short positions which were in profit. This is in order to balance out the liquidity pools. It's important to note that this protocol is only triggered, like we just mentioned, in extreme volatile markets. And not all the futures platforms use this method. But if you do look over the metrics, those that do implement ADL did very, very well. Those that didn't are in a little bit of trouble.
I think you just tying this back to during the floor, kind of TradFi, etc. Obviously, recently with like Trump headlines and stuff, it's been very, very easy to pinpoint a market move, pinpoint a reason, like a tweet, even a specific tweet to a market move. Now, what people need to understand is this is quite a recent phenomenon in terms of, like, going back over the last couple of decades where I've been involved in markets. Because previously, there would be a combination of things that you could put a big move down to, but you were unsure exactly what triggered it, and one turns into another, which turns into another, and it's a whole it's a whole basket of things that might have come up that have actually led to a prolonged, significant sell-off rather than just one headline. Obviously, it's most likely now in the world we live in, a big like a big crash. I say a crash. I hate using that word unless it's done within about a second, but a significant sell-off, etc., that takes hours or even days. It's hard to, it's much easier to pin down on a catalyst. Now, I think you raised a very good point there, and it's worth saying that sometimes, still now occasionally, there are times when you don't know what the significant original catalyst was, and anyone that and sometimes when you see people specifically on social media where, we have a lot of tourists and a lot of people claim to know far more than they actually really do. And they say with certainty, oh, this sell-off happened because of this. Sometimes that's absolute bollocks. And sometimes, like you said, and very well put, and this is why I love doing these shows with you, because, you're only a young lad, but, you have got a very old head on your shoulders. It's good to acknowledge when potentially there wasn't one individual catalyst, it was a combination of them. And I think that's something just, people might be sitting there listening to us going, what the fuck's Ryan going on about? But I think these points are worth mentioning and worth highlighting because they do help build up your market knowledge.
Yeah.
Yeah.
And thank you. And thank you. No, it really is that. It's that simple. And I suppose now we've got like individual data down to the tick size. And I spent quite a lot of time last week going through the individual ticks around that post from President Trump. And there were so many different factors. If you look at Hyperliquid, look at Binance, look at their exchanges, there were wallets that, like new wallets, that front run the announcement and were able to execute enormous trades before anybody else. And that meant that they were able to time the bottom of the market move as well as the top and shorting it and going on the long side all the way back up to 106. So it's really very difficult. And that amount, again, I suppose ultimately it was recorded that this contributed to around $19 billion in liquidations over a 24-hour period. However, I believe, and I've read some reports from on-chain experts as well, and they're in the same mind that this figure is actually a lot higher, hence the reason why the market sold off as drastically as they did. I think this liquidation figure is in excess of $100 billion.
Oof.
And not 19. And then it's quite
a bit of a difference there.
Yeah, and why is this? Well, one particular reason, this isn't the main reason, but this is one individual reason, is that the reporting method for exchanges. Now, one of the leading crypto exchanges, I'm not going to name them, that offer futures trading can only report a maximum of 100 liquidations per second. Now, in your usual market conditions, this number is, likely not an issue. However, when volatility increases as such to a degree that we saw, on the 10th of October, more than 100 traders or trades were getting liquidated in a second, which meant there were vast gaps in reporting on these APIs that get fed out to all these analytic companies of the true number that were getting liquidated. The sexes which, not decentralized exchanges, but centralized exchanges that have their own policies of reporting, they are able to gatekeep the true data, not share it with others. OKX, the guys over there, and they're basically saying that the very, very similar thing where with the centralized exchanges that they're allowed to gatekeep a lot of these data points. Difficult to do from decentralized exchange point of view. Hyperliquid, quite honest with their APIs that they were pulling in a lot more than 100 liquidations per second. But some of the top exchanges, they're hiding that figure. Not whether it's with malicious intent or not, that's not for me to say at all, and that's not the point I'm trying to make here. It's just that the $19 billion that recorded did not capture the full extent of the liquidations within that 24-hour period. So really important to note because, again, going back, I know we spent quite a few minutes on it now.
But as you know, I'm never against spending time when we're adding value and we're actually when we're getting into stuff that's worth getting into. I think it's time well spent.
Yeah, no, exactly that. So why is that number so big? Well, like we mentioned at the start, there's not a single point of, a root cause, but there were several leading factors that basically added up to that catalyst there of BTC pulling down so fast. However, As Ryan highlighted right out the gate to the podcast today, Bitcoin's above $100,000.
There we go. Right? Exactly.
It's well above $100,000. Not only is it above $110,000, it's above its 200-day moving average, which is over $108,000. It's structurally really solid.
This is it. Exactly that. It's very, very easy, especially when, again, I mentioned at the start of the show, crypto markets, 24-hour, market opening. It's very easy for traders to live tick by tick. And I promise you, your life becomes so much simpler, so much better, and often far more profitable when you zoom out.
Exactly that. So moving on with the crypto market update, Ethereum is currently trading at $4,030, up 16% since the low on October 10th of $3,440. Last week, so from October 13th to 17th, spot Bitcoin ETFs saw a net weekly outflow of $1.2 billion, the second highest on record, with none of the 12 ETFs reporting net inflows. Spot Ethereum ETFs recorded a net weekly outflow of $312 million, with BlackRock's ETH leading the outflows of $245 million. As of tomorrow, I think we're going to be able to start reporting on UK crypto ETFs.
Oh, right, our friends at Bitfinex, ones.
Bitwise, yeah, absolutely. They've got product launching.
Do you know what I was thinking of? I was trying to say their Twitter handle at the same time as trying to say the company name, so that's why I was getting a bit all confused.
Bitwise Europe. There we go.
That's it.
Yeah. Shout out to our friends over there at Bitwise. We know that they've been working really hard on their ETPs, especially for Europe, and now here in the London with the LSE listing some of those. If we look down the altcoin sector, BNB trading at $1,113, XRP at $2.47, and Solana trading at $191. Interesting, again, these prices, compared to when we were doing these spaces just 2 weeks ago, drastically different. But notably, BNB is very, very strong at the moment, well above that $1,000 mark, which when we started the spaces, I believe BNB was trading around $400. So massive improvements on their side. Let's jump into the sector updates. We've got quite a bit of news that we'll go through here. So Japan's Financial Service Agency is considering revising regulations to allow banks to hold cryptocurrencies such as Bitcoin for investment purposes. The move aims to align with the growing trend of crypto trading, enabling banks to trade digital assets like stocks and government bonds. In addition to this, regulators plan to let banking groups register as crypto exchange operators to enhance market trust and make it easier for individual investors to participate. Again, the thing that we keep mentioning on the Crypto Blast, lowering the barrier to entry. Well, Japan are looking
exactly, and that's kind of been a theme since we've been starting these. Is there's been almost like every week we find that that bar being just dropped a couple of inches more every kind of week or so, and I think that's what we need to keep seeing, and long live it.
Yeah, exactly. Staying over in Japan, so Japan's three largest major banks are collaborating to launch a stablecoin pegged to the Japanese yen and US dollar. The initiative aims to facilitate seamless cross-border settlements, with Mitsubishi Corporation serving as the first application scenario. The three banks collectively have over 300,000 major business partners, again expanding their reach with the stablecoins out over in Japan. Sticking in Asia, according to the Financial Times, Alibaba's Ant Group and JD.com have paused their plans to issue stablecoins in Hong Kong after receiving instructions from the Chinese regulators, including the PBOC and the CAC, to halt the projects. Hong Kong passed the stablecoin bill back in May, establishing a license regime for fiat-backed issuers, with both Ant and JD previously saying that they would join the pilot. French regulators have expanded their anti-money laundering checks on cryptocurrency exchanges, including Binance. The ACPR is carrying out controls of dozens of exchanges, an effort that started late last year. Binance put on a post on X saying that it's fully cooperating and complying with the EU and local regulations. According to the FT, the UK tax authority, the HMRC, sent nudge letters to around 65,000 suspected crypto tax evaders. Quite a large number. That number, in fact, doubled from last year. The HMRC will use exchange data to track evasion and, from 2026, collect detailed user info under the OECD's CAR framework. In the UK, selling or spending crypto incurs capital gains tax, while staking and airdrops count as income. According to Bloomberg, sticking here in the UK, the Bank of England Deputy Governor said that the central bank is considering temporary limits on holdings and transactions for systemic stablecoins to prevent potential disruptions to bank deposits and real economy financing. The proposed caps is £20,000 for individuals, £10 million for businesses, may be adjusted and be lifted once the risks subdue. Again, sticking in the UK, Bloomberg is reporting that Bank of England plans to introduce stablecoin regulations by the end of 2026, over a year away. With the public consultation set to begin November 10th of this year, the proposed framework will take cues from US rules, requires reserve assets to consider primarily of government bonds with maturities under 3 months. It will also allow interest-bearing assets to incentivize issuers and support demand for UK sovereign debt, which is interesting because that's currently under the Genius Act is not something that's possible. So there we go.
There you go.
The UK taking something from America and kind of improving it, which is it's great to see that.
Yeah.
According to Bloomberg, Bitcoin mining firms are once again outperforming the cryptocurrencies itself as more shift to hybrid models combining artificial intelligence and high performance computing. Once linked to gold miners, these companies have long been tied to Bitcoin's price swings. They benefit from an early AI boom 2 years ago and later saw shares fall as mining profits declined and competition intensified. Several crypto company executives will attend a roundtable with pro-crypto Senate Democrats this Wednesday to discuss market structure legislation and the industry outlook. Expected participants include executives from Coinbase, Chainlink, Galaxy, Kraken, Uniswap, Circle, Ripple, the list goes on. The meeting is led by Senator Christine Gillibrand. A little warning and a nice stern reminder, really, not a nice reminder. A US user lost $3 million in XRP after their EliPal hardware wallet was hacked. The stolen funds were moved via bridges and laundered through an OTC channel tied to Huan, a Southeast Asian platform recently sanctioned by the US regulators for fraud and money laundering. Unfortunately, how did this person lose their funds? Because, as we mentioned at the top of the story, they were held cold wallets. There was an application that basically linked his hardware wallet into it, which turned it into a hot wallet, which meant that the attackers, as you would call them, were able to infiltrate his hardware wallet and steal his funds. So, essentially making that hardware wallet exposed to the internet. So just a real stern reminder, if you have cryptocurrencies, make sure that you understand the application that you're plugging them into, if and when it comes to that, because you don't want to be falling victim to a scam. Feel bad for that guy. According to Galaxy Research, since March, the US government has authorized the Treasury to include seized digital assets as part of its strategic Bitcoin reserve, with assets from the recent price group forfeiture added. The reserve grew 64% overnight, now equal to 3.5% of the US gold reserve by dollar value. The United States government now holds more Bitcoin than any entity except MicroStrategy. That's a lot of Bitcoin.
That's a lot of Bitcoin.
So according to Bloomberg, a new report from 10x Research shows that retail investors have lost an estimated $17 billion while trying to gain indirect exposure through digital asset treasury firms, such as Metaplanet, Michael Saylor's strategy. The losses stem mainly from excessive equity premiums, which allowed these companies to issue shares at valuations far above their actual crypto holdings. The Swiss gambling regulator has filed a criminal complaint against FIFA's World Cup NFT platform, alleging it offers unlicensed gambling services in Switzerland. The complaint centers on FIFA Collect, which runs NFT-based competitions requiring monetary stakes with cash prizes involving chance-based outcomes classified as lotteries and sports betting under the Swiss law. We just mentioned it a story ago. The US government seized around 127,000 BTC, over $17 billion, linked to the Shenzhen leader of Cambodia's Prince Group, responsible for a large-scale crypto scams. These were butchering scams when they happened. So yeah, they've basically been confiscated. How did they get these Bitcoins? Well, they talked about a weakness in the key generation. They put that statement out there over a year ago, saying that the keys were vulnerable, and some really smart people were spending a lot of time, I imagine, at trying to crack these keys, and eventually they did, and they managed to seize these Bitcoins. So if you've got some Bitcoins in an old hardware wallet, maybe think about changing that wallet to a new address.
Yeah, right.
Because the US government have proved that they can crack it if they find that it's not secure. According to Bloomberg, Ripple Labs is leading a fundraising initiative at least $1 billion, aiming to establish a new digital asset treasury to accumulate XRP. The
No
fund will,
surprise there. Which
no
one?
surprise. Yeah.
Imagine if you would have said like some other currency, though,
Yeah.
something like that. You're going, what?
Ripple tries to raise a DATCO against BNB or something like
Yeah.
that. So the funds will be raised through a SPAC purpose acquisition company, and Ripple will also contribute a portion of its own XRP to the treasury. SEC Commissioner Hester Peirce stated that the Washington Privacy Summit that tokenization has become a core focus for the SEC. She noted that the commission is working with Congress on digital asset legislation that addresses token issuance, classification of transactions, and custody rules. The CME Group reported in its Q3 2025 earnings release that the total quarterly trading volume for crypto futures and options surpassed $900 billion, with a B, setting a new all-time high. $900 billion is just absolute. I know we throw around these figures, especially over the last 6 to 7
exactly
months.
that, right? Exactly. You got to take a step back sometimes. Again, if in doubt, zoom out and think. With the numbers we're talking about now are insane compared to just a couple of years ago. And fair play to the likes of CME, except for really like kind of again lowering the barriers to entry for trading, because there's believe it or not, for a long period of time it was easier for retail punters to trade crypto than it was institutional traders. And the likes of CME putting these contracts on clearable exchanges means that all of a sudden you can trade via it. You can hold positions in these currencies and stuff as a trader at a bank or as a trader at a hedge fund, because it's believe it or not centrally cleared, which maybe goes against the whole decentralized aspect of crypto, but you need that because you need to scratch that itch for your compliance departments, etc.
Well, the US government is the second largest holder of Bitcoin, so there we go.
Right, exactly.
Yeah, absolutely. Kraken announced the $100 million acquisition of Small Exchange, a CFTC regulated designated contract market from IG Group, expanding its footprint in the US derivatives market. This move makes Kraken one of the few trading platforms to hold derivative licenses across the US, the UK, and the EU. So a very, very large market share there. Kraken. OKX announced a partnership with Standard Chartered Bank, integrating the bank's regulated custody services into OKX's European institutional framework. The collaboration will support safeguarded collateral mirroring and enhance asset protection, offering institutional clients a more secure and effective trading experience. And lastly from me, a story which makes you think, how on earth did this happen?
Oh, go on. I'm looking forward to this now. You picked this up.
At 3 p.m. Eastern Standard Time on October 15th, Paxos mistakenly minted 300 trillion. What? Right. Yeah. So
talking about big numbers, we were just saying these numbers we're talking about are big. But there's big and there's what the fuck big.
Yeah, exactly. When I saw the alert across my screen, I generally had a headache trying to work out how many zeros were.
I'm glad you said that, because when I saw it got tweeted originally, before it was tweeted, so I saw the tweet go out, someone raised that they'd just done this, but no one mentioned it was a mistake or anything. And I looked at it, and it was one of those moments where I thought, you crazy kids, there's obviously a reason why this makes sense, but to me, it's just looks like complete gobbledygook. And I was sitting there, I was like, oh, it must be me. Yeah, it must be me being stupid. I'm not going to ask anyone, hang on, how is this even possible? Because I thought
I had to copy paste the number into Google just to make to quadruple check. I was like, what?
There's so many zeros you lose count.
Yeah. I was like, they're blurring into one. So they managed to mistakenly mint 300 trillion PYUSD. The excess tokens were fully burned in 20 minutes. So it took 20 minutes in order for them to go, oh, hold on a minute, there's a mistake here. So Paxos are attributing this incident to a technical error, confirm that no systems were compromised and that customer funds remain secure, blah, 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 blah. I say blah, 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 because somehow they managed to make, if you track the transaction, they managed to make over $1.3 billion on fees with this mistake. So they managed to generate,
have they refunded those fees?
No, it's their own company. I'm not entirely sure
Hang on, what?
But
So
if you
they've
look
charged
at,
them. Sorry, they've
if
charged
you look on
themselves.
chain, yeah,
So who paid this fee then? Who paid?
this is what I don't understand. They managed to generate over $1 billion.
What? Someone's had to have paid that though.
Yeah, yeah. But obviously, the money's got to come from somewhere.
Well, and if you can't work out how, but they're claiming those fees as revenue, and they still haven't taken those off the. Okay, right. Let me get
Sorry,
this straight.
I tell you what, we'll join on Wednesday. Join back on Wednesday,
Okay,
and we'll
but
come up with a full
just from
detailed
where I'm
report
sitting
on
on this straight away, and again, this is the first time I've heard of it, so forgive me if I'm talking out my arse. Well, I normally do when I've had weeks to discuss something, but there we go. So they've erroneously, air quotes erroneously, no one can see me air quotes, that's standard, erroneously done 300 trillion in fake money. They've then claimed $1 billion in fees. They've undone the trillion, burnt it off, but they're still claiming the fees. Now, if they've done this, they've just basically, well, in theory, created the glitch in the matrix, which is the free money printing press. However, if no one has been the other side of this transaction for the fees, and they're literally claiming these for their balance sheet, this is outright fraud.
Yeah. No, so many more questions are raised.
Can I short the company behind this? Is my next question.
I'm sure with our friends over at Vest that might be possible.
There we go. Actually, yeah, right. Remind me on Thursday when we chat to them.
Yeah, exactly. Yeah, I'll tell you what, everybody's listening, and you're going, what the hell?
Join the club.
Tune in Wednesday.
If anyone out there before Wednesday, if anyone could text me what the hell is going on, so I actually have some idea of how to chat to Cam about this, because this is blowing my tiny little mind.
It's blowing mine, and I was looking on chain at the images for it. So
that makes me feel a lot better, to be fair.
We'll get it up, and we'll do a little bit more digging. Maybe we'll add it into the post, certainly into the Institutional Fire newsletter as a little segment on Wednesday.
Love it. Well, Cam, on that bombshell, on that $1 billion bombshell, thank you so much as usual. Apologies that we've been a bit lapse in these. We need to kind of fix ourselves up and get these back being more regularly Monday, Wednesdays and Fridays as they should be. But yeah, whatever you're doing, thanks for listening. Keep it tight, stay safe, and we will see you all on Wednesday.